Welcome everyone to the 7th Annual Monetary and Financial Policy Conference of the Money, Macro and Finance Society. My name's Paul Misnon, I'm the chairman of the MMF, and I'm very pleased to be able to introduce Sarah Breeden to give the first webinar in a series of 5 that are hosted over the next 10 days. Sarah is the Executive Director for Financial Stability, Strategy and Risk and a member of the Financial Policy Committee. She also leads the bank's work on climate change domestically and internationally. This includes being chair of the macro financial workstream of the International Central Bank and Supervisors Network for Greening the Financial System, or NGFS. Prior to her current role, Sarah was the Executive Director for UK Deposit Taking Supervision, responsible for supervision of the UK's banks, building societies and credit unions. Before that, she was Executive Director for International Bank Supervision, where, having joined the Directorate in 2015, she was responsible for supervision of the UK operations of international banks. Before moving into supervision, Sarah worked on the development of the UK's macro-prudential policy making framework and assessment of risks to financial stability from financial markets. She also led the bank's work to support the transition of prudential regulation of banks from the FSA to the bank. So today, Sarah is going to talk about sustainable finance and central banks. And there will be opportunity to ask questions through the Q&A function. But please note that we're in the quiet period for the Financial Policy Committee meeting, which is upcoming. So Sarah can only really ask questions about the presentation today or matters that are already in the public domain. So Sarah, over to you.
Thanks, Paul. It's a pleasure to be here. Throughout the past 300 years or so, the Bank of England has been charged with promoting the good of the people of the United Kingdom, now defined as maintaining monetary and financial stability. Although our mission has remained the same, our approach to fulfilling it has developed in tandem with the changing landscape of our economy and of our financial system. The bank has had a front row seat to many historically significant events. From the first financial crisis in the bank's history, the South Sea Bubble back in 1720, to 2 world wars. More recently, the bank has seen the financial system of the UK economy through both the 2008 financial crisis and the COVID pandemic, where we saw the worst economic outturns in 3 centuries. And for the past 6 years, the bank has been responding to what I consider to be the defining challenge of our generation, climate change. Now, the science supporting climate change is plain. The latest Intergovernmental Panel on Climate Change report states that human influence has unequivocally warmed our atmosphere. And in fact, we've already warmed it by around 1 degree Celsius relative to pre-industrial times. Existing commitments from countries to reduce emissions are not enough to keep warming to well below 2 degrees, let alone 1.5. In fact, the IPCC estimates that we will reach 1.5 degrees by 2040, even under their very low emissions scenario. The case for action is therefore clear. The question is whether our actions will match that case. And I'm pleased to say that momentum is growing, but there is much, much more for us all to do if we're to turn aspiration into action. As central bank and regulator, we must think about the impacts of climate change on the financial system and the macroeconomy. These arise through 2 sources. First, as the red box on this slide highlights, these risks arise from the physical risks of our planet getting hotter, severe flooding, increased heat waves. These cause losses in infrastructure and productivity that impact asset values, hurt profitability for businesses, and damage public finances. And as the blue box shows, they arise also from transition risks, changes in government policy, technology, and consumer preference that move our emissions pathway towards one that is consistent with net zero. For example, fossil fuel reserves could lose value and become stranded, but the impact will be much broader. It will affect users as well as producers of energy, and we need to take into account other sources of emission too. Perhaps cows are the new coal. What I hope the slide highlights is that these risks are simultaneously uncertain and yet totally foreseeable. I cannot tell you now exactly what combination of physical and transition risks we will see, but I can say with absolute certainty that either we carry on our current emissions pathway and face physical risks, or we change our pathway and we face transition risks. What the slide also reminds us of is that the size and the balance of our future risks will be determined by the actions that we take now. Carbon released today remains in the atmosphere for years. Similarly, with a fixed carbon budget, the longer that meaningful adjustment is delayed, the more disruptive a transition we will see. So the cold, hard climate physics means that what we do now determines our future physical and transition risks. And so to minimize those risks and costs, we need to stretch our horizons and take different decisions now, well before the consequences of our inaction become clear. Now, of course, change needs to happen in the real economy. Consumers, corporates, governments all need to act. But the financial system has a crucial role to play in addressing these risks too. As I will cover later, understanding exactly how climate change creates economic costs and financial risks is hard, and much more work is needed. But by way of example, analysis by the Swiss Re Institute estimates that if no further mitigating actions are taken against climate change, global GDP will be as much as 18% lower than it would have been by 2050. And of course, this is not a classic business cycle shock from which we can expect readily to rebound. Climate change is irreversible. So as a regulator and as a policymaker, all this puts climate change squarely within our remit. We will not save the planet. Those with the tools to do this sit elsewhere in government and in industry. But central banks have an important role to play in ensuring that the financial system is able to respond to the risks, that it can support the transition, and that we take account of the macroeconomic impacts where those are relevant for the conduct of monetary policy. So today, I hope to set out what the Bank of England's role is in all of this as the UK's central bank. It's a wide canvas. Like all structural changes, it affects everything we do. So please forgive me if it feels like a quick talk, but we can dive into the detail in questions. In addition to providing an overview of our work, I'll aim also to share where we think there's further room for research, since that, I hope, is of wide interest to you all. So, what have we been doing? And what have we learned so far from our climate work? It's always been obvious that climate change matters for the environment and for our planet. But what's self-evident now, even if it wasn't 5 years ago, is that climate change creates financial risks that matter for individual firms, and depending on the speed at which they crystallize, perhaps the stability of the financial system as a whole too. The financial system also has a crucial role to play in addressing these risks, both as it greens finance by transforming risk management so that financial decisions take climate risks into account, and as it finances green through innovation and investment choices that will drive the transition to net zero. Our first step as a policymaker came in 2019, when we became the first supervisor in the world to set supervisory expectations for banks and insurers to manage the financial risks from climate change. These expectations are designed to ensure that firms take a strategic, forward-looking approach to managing climate-related risks that's embedded in their business-as-usual risk management, but importantly grounded in the long-term financial interests of the firm. Suffice it to say, that's easier said than done. We've therefore established the Climate Financial Risk Forum, chaired by the regulators, but working with industry to build expertise and share best practice on what good climate risk management looks like. Our aim here is to ensure that no one has the excuse that they do not know what to do. In addition, we've worked with government and other regulators on reporting and disclosure. And that, of course, is essential because firms cannot manage or price or trade what they cannot see. Now, of course, we need consistent, comparable, decision-useful information if we are to do that well. And the good news is that the UK government has announced its intention to make disclosure mandatory across the economy by 2025, with significant progress made by 2023. The bad news, however, is that yet again, that's not as easy as it sounds, because as you saw earlier, climate change is a risk we see looking forwards, not backwards. And so without what-if scenario analysis, on which more later, it's hard for us to see who the leaders and who the laggards are. We're also helping others with their work on financing green to steward the real economy to net zero, both by channeling investment to reduce carbon emissions and through innovation in identifying new financing solutions to fund real-world transition challenges. The need to retrofit 30 million homes for net zero, for example, it is a huge agenda. But a really important part of our work on risk is to consider climate risk top-down at the level of the system, consistent with our objective to safeguard financial stability. Scenario analysis is the key tool to do this because it allows us to look ahead at a range of possible outcomes. Scenario analysis, however, is fiendishly complicated. As this slide highlights, plotting the transmission channels of climate risks into economic and financial risks is no easy task. The channels from climate to financial risk are numerous, with significant interdependencies that mean it's best understood at a granular level, bottom up, rather than top down. The data and methodologies to translate climate outcomes into macroeconomic and financial risks are incomplete and inadequate. And of course, as we saw, the future path of climate risks themselves is subject to huge uncertainty. The whole exercise is complex and complicated. Given the modelling gap in this area, we launched a project to co-design climate scenarios with a consortium of world-leading climate scientists and close to 60 other central banks and supervisors under the macro financial workstream of the Central Banks and Supervisors Network for the Greening of the Financial System, the NGFS, which I chair. We learned some valuable lessons in the process, and I wanted to share a few with you. First, we often talk about how much we don't know, but this doesn't do justice to how much work has already been done. As you can see on this slide, we have a clear picture of where our emissions come from, and so we know what the building blocks of the transition are. These include increasing the share of renewables in the energy mix, greater electrification, including of vehicles, improving energy efficiency, implementing more sustainable agricultural processes, and where possible, capturing and offsetting emissions. A number of different types of policy measures can help us get there, and I'll touch on this later. Second, we've learned that the cost to the economy in aggregate of getting to net zero need not be substantial. Our latest economic modelling shown on this slide suggests that reaching net zero, if the transition is managed well, might have a small or negligible effect on economic aggregates such as GDP, unemployment, and inflation. And in fact, the Climate Change Committee's 6th carbon budget estimates the net cost of meeting the budget to be equivalent to less than 1% of GDP. We do, however, also know that those costs depend on whether the transition is orderly or disorderly. And we know that it takes time to implement policy and for markets to adapt to changes. That means that if meaningful action is delayed by another decade, the transition would need to be much sharper, with GDP in 2050 more than 7% lower than in a world where we acted today. In addition, physical risks would be higher, leading to higher costs later in the century, again underlining the importance of early action. The third thing we've learned is that the impact from physical risk will be significant. Even if we limit the rise in global mean temperatures to 1.5 degrees, physical risks are likely to dominate the potential impacts of the transition. And if instead we continue on our current trajectory, well above Paris goals, global losses just from the impacts of physical risks on labour and agricultural productivity could be as high as 13% of GDP by the end of the century. And that's before we've started to account for sea level rise, more chronic weather events, mass migration, increased conflict, and food scarcity. And of course, high levels of warming are unprecedented, so we're unlikely to be able fully to understand the delicate balance between the climate, living conditions, ecosystems, and our economy. But what is clear is that investment is needed now to help adapt to these inevitable physical changes, and that we should recognise the gaps in our understanding of how large changes to our climate might affect our economy. And so we should err on the side of caution, as the stakes are simply too high. The Bank of England is pursuing its own scenario work based on those developed by the NGFS. In June, we launched the Climate Biennial Exploratory Scenario Exercise, or CBES, where we're working with the largest UK banks and insurers to get a better understanding of climate risk. This is our first exercise that includes climate as well as economic and financial outcomes. As shown on this slide, we're using 3 scenarios: no action, late action, and early action, to explore different combinations of physical and transition risks. We're going to look ahead decades, not our usual 3 to 5 years, and we will ask the banks and insurers that are participating to undertake granular counterparty level analysis. This is not a straightforward ask. That's shown on this slide, which highlights that our exercise aims to do 3 things. First, to try to size climate risks by shining a light on risks that are currently opaque. Second, to highlight where there are opportunities to reduce that risk, and so to identify where firms and their customers' business models need to change, both what business becomes unviable and, importantly, what new business needs to be done. And third, we aim to build firms' risk management capabilities, prompt customer engagement, and support that strategic long-term approach to managing climate risks that I mentioned earlier. A crucial part of this exercise is that firms and we are learning by doing. It really is an exploratory exercise, but it's a hugely important one. The fact that the risks are complex and complicated to understand does not take away from the need for an urgent response. I've covered so far what we know from the work that we have done, focusing particularly on scenario analysis. And what I want to do now is try to paint a picture of what we don't yet know and to where our collective efforts should increasingly turn. First, I want to say a word on policy levers. Our NGFS scenarios use a shadow carbon price, which serves as a proxy for a range of different climate policies, whether carbon taxes, business regulation, or investment in research. In aggregate, these climate policies need to create a relative price shift that internalizes the costs of emissions and drives that economy-wide shift to net zero. Our NGFS analysis suggests these will need to add up to an equivalent global shadow carbon price of over $150 a tonne within a decade if we are to reach net zero by 2050 in an orderly way. Now, to put that number into context, the UK emissions trading scheme opening price was $70 per tonne, and the average global price of carbon today is just $3 a tonne. It's clear that globally we're still far from capturing the true cost of emissions, and therefore investments being made today lack crucial pricing signals that could otherwise fundamentally change investors' decisions. Greater clarity on carbon pricing and the trajectory of public policy would support the financial system in pulling that transition forward. And in that context, I think it would be helpful for policymakers and researchers to work together to anticipate the challenges and opportunities that come with different approaches to climate policy and carbon pricing, to further understand the right mix of policy tools to support a swift yet smooth transition to net zero, and thirdly, to develop comprehensive frameworks to better capture the impact of this mix of tools on the economy. Now, let me turn second to macroeconomic implications. As central banks and supervisors, we will need better to understand how climate risks affect the economic outlook in order to consider our potential policy responses. As I showed you earlier, the NGFS has started to explore this. In our most recent update to our scenarios published in June, we included a macroeconomic model to provide more detailed economic outputs. We used NIGEP, a global economic model, and tailored it specifically to the NGFS scenarios so that it could capture changes in the economy resulting from the transition in the energy system and rising carbon prices. But more research will be needed as the impacts of climate change and the transition to net zero starts to come into sharper relief. Specifically, there are 4 key areas where we think there is need for further work and research. First, further integrating climate and macro modelling. Climate models typically don't model the economy in much detail, and macro models don't capture climate risks well. So we need to do more work on integrating models across the different disciplines if we are to do a better job of understanding what might happen. Secondly, understanding and sizing the different transmission channels and on improving our understanding of how they interact. Thirdly, going beyond the aggregate impacts to understand the distributional implications, whether across sectors or geographies. Within the NGFS, we're currently exploring whether we can expand our scenarios with a sectoral model, but there's a lot of scope for further work in this area. And then finally, assessing how the transition might affect the demand and the supply sides of the economy. The effects of climate change and the transition to a net zero economy are going to manifest over time, so our analysis needs to span the short, the medium, and the long term if we are to capture fully these effects. And to address these areas successfully, academia, practitioners, and policymakers will need to continue to work closely together. We are committed to do what we can to support this. Indeed, we're hosting a conference jointly with the Banca d'Italia on the macro financial impacts of climate change and the net zero transition next month. This is a journey we're only just embarking on, and I hope this conference can play a key role in facilitating these discussions ahead of Glasgow. And I'd like to extend the invitation to join this conference to all of you here today. Third, on monetary policy. Research around the monetary policy implications of climate change and the transition to net zero have only started to emerge in recent years. Perhaps somewhat oddly, rather more focus appears to have been given to how central banks could use their balance sheets in the implementation of monetary policy to support the transition to net zero than has been given to an analysis of the consequences of climate change for the monetary policy stance. We know that domestic and international climate policy will have an impact on inflation, on growth, and on labour markets. And we know the impacts will become larger as more ambitious climate policies are implemented. It's also clear that the physical risks from climate change will impact macro variables. Changes in weather patterns and increased reliance on bioenergy could increase the volatility of food and energy prices, and hence the volatility of headline inflation rates. We also know that if we want to meet climate goals, we will need a structural shift across the entire economy. And that will matter for monetary policy, as these shifts can affect not only future point in time macroeconomic variables, but also expected long-run steady state variables, whether the natural rate of interest, R*, or the natural rate of unemployment. Indeed, we might even find that clarity on climate policy is a spur to investment and productivity growth, and so a rise in R*. Much more work needs to be done to understand the impact from climate change and the transition on, firstly, the transmission mechanism, secondly, macroeconomic variables for the conduct of monetary policy across different time horizons, and thirdly, the natural interest rate. And it goes without saying that these considerations need to be embedded into our economic modelling. The unknowns I've just talked through, policy levers, macroeconomic impacts, monetary policy impacts and responses, are all ripe areas for further research. We are now in the final weeks leading up to COP26, and the science tells us we're fast approaching a point of no return for the planet. That means we all need to step up if we're to close the knowledge gaps in time for the information to be decision useful and actionable. So let me end with a call to action of my own by encouraging you all to pursue or support the types of research efforts I've mentioned today, and to work collectively in making strides to swiftly and comprehensively fill these knowledge gaps. It's an ambitious ask, but humanity is known to achieve the impossible where there's a will and where there's a way. Let's get to work. Thank you.
Thanks very much, Sarah. That's very helpful and informative. And I'm going to hand over now to Tony Hughes. Tony is a consultant at Grant Thornton and a columnist for the Global Association of Risk Professionals. And he has a PhD in econometric theory from Monash University in Australia, has a long career in credit risk modeling and research across many continents. And he's written the risk-weighted column for GARP since 2018. And from his previous roles in Moody's Analytics in the US, he spearheaded some developments of a large number of tools for use in stress testing. And since moving to the UK, he has focused on modeling the changes posed by climate risk. So Tony, over to you for your comments and any questions you might have.
Thank you, Paul. I must say that it's an honor to be here and to be following such a great speaker as Sarah. Today, the title of my comments will be evidence-based climate stress testing, and I'm going to focus, as Paul mentioned, I mean, I come from a modeling background. So I was an academic in econometrics, and I've subsequently worked as a risk modeler for many years. So my focus is on, data, building models and interpreting models. And it makes sense that, with this type of background, that I would face up to the most important challenge that we currently face as an industry and as a, and basically for humanity, essentially. So I think this is the issue of our generation, and it's one that I certainly want to be involved with to try to, advance the cause and to find evidence and to use evidence as efficiently as possible as we do this. Now, so today, there really are two questions, and Sarah already has outlined both of these. I'm actually going to focus on the first of these, which is the risk that climate poses to bank safety and to the financial system more broadly. There is a second set question, which is equally or more important, which is whether financial forces can be harnessed to tackle climate change. So like I said, here I'm going to be focused on the risk that climate poses to the financial system, and I'm deliberately going to not discuss the other question very much. But one thing that I do want people to take away from today's talk is that taking action to correct global warming does not in any way, shape, or form depend on financial vulnerability. So what I mean by this is that, there's an open question about how robust the financial system is to climate change. And I'll be going through some of the evidence on that question today. But in a sense, the answer to that question doesn't really matter, because we know that there are substantial impacts on humanity that are caused by climate change. And I would argue that the impetus, the need for us to act on climate change has already been established. If it turns out that the financial system is actually surprisingly robust to climate change, then that's fantastic. And that will actually give us increased scope to take some of the corrective actions that Sarah has already described in her remarks. So if we're talking about the evidence related to climate change, we can point out that despite 50 years of global warming, or more than 50 years of global warming, a very well-established trend to higher temperatures in the atmosphere, and despite increased peril from global warming in the form of increased hurricanes, the fires in my home country of Australia, I could go through a litany of different examples. But despite this, what we find is that the evidence that past climate change has impacted the financial system is frankly underwhelming. The quotes that I'm going to talk through today are all extremely recent, so all from the current month. So earlier this month, The Economist put out an article that described the evidence for that global warming or climate change could bring down the financial system. They described that as underwhelming. And then just last week, just within the last few days, the ECB released early results from their stress test, which is a parallel stress test in line with the CBES. And one point, so when they turned to corporate PDs, counterparty probabilities of default, which was the main focus of the stress test, they found that under a hothouse world scenario, so a no action scenario, that median PDs would rise by only 7%. Now, we need to bear in mind, of course, that in a tail portfolio that the ECB also analyzed, they found a more substantial rise for that tail portfolio, and they found a 30% rise, which is, to put it into context, it's like going from a 2% PD to a 2.6% PD. But if you think about something like the global financial crisis back in the late 2000s, what you find is that you can find mortgage portfolios where the probability of default rose by 2,000%. and that with the types of substantial shocks that were capable of bringing about large-scale or widespread bank defaults, bank failures. And that's what most people would typically view as financial stability. So the interesting question in my mind is, why, despite half a century of climate change, do we still observe such modest changes in financial performance in terms of things like credit risk and so on and so forth? And that's really what I want to discuss and want to focus on today. So if we start by looking at this chart, what you'll see here is I've plotted two series here. One is global temperature anomalies, which is in orange, and I've aggregated these in a slightly unusual way, so they're quarterly averages. But nonetheless, you can see the trend there. I could obviously pull the curtain back on this series, back almost a century, and it would demonstrate that the trend to higher temperatures has been unfolding for at least the past 60 years. I've then plotted this against US commercial bank total delinquency rates, or C&I loans. And I'm using US data here just because it's convenient, because it has a very long history and everyone sort of is aware of the economic history of the US, and so the timing of recessions and so forth. So what you can see here in the blue series, so a couple of things to note here. The first is that the trending nature of climate is one of the most difficult things, aspects of this problem to model, because there are various other economic variables that have also trended over this period. So we could look at things like, interest rates, for instance, have trended lower since the mid-1980s. We could look at something like the male labor force participation rate, which has also, been trending lower over this period. And also something like, the third thing I pointed out was that the population has aged over this period as well. And so these are all long-term economic trends. And so what this means is that if we can find trending factors in, for example, credit risk data, then we still face an identification problem, in the sense that it will be very difficult for us to convince ourselves that climate is actually driving that trend behavior, as opposed to one of these other trending factors that are also present in the economy. Now, the way that you go about, comforting yourself that climate is actually driving the underlying trending factors is by looking at or trying to find natural experiments. So these are situations where one population is affected by a climate-related shock and another population or an adjacent population is unaffected. And there are many examples of these natural experiments, and I'll talk through a few just in a minute. But the point here is that it's very difficult to capture the trends and to be able to actually model them and project them into the future. One point to note here, of course, is that if anything, the credit data here is trending lower over time. And indeed, there's a correlation that's negative between these two variables. Now, I'm not going to fall for the spurious regression trap, but what this does suggest to us is that if there is a connection between climate and credit risk, then what this chart is telling us is that banks are adjusting their underwriting quality criteria dynamically over time in such a way as to keep the observed performance of the aggregate portfolio in line with this declining trend. And personally, I think the declining trend is due to improved technology in the form of data and analytics that help us to drive towards better underwriting decisions, broadly speaking. Now, the other point to note here is that if we overlay the 30% result from the ECB onto this chart, bear in mind the current delinquency rate for CNI loans in the US is about 1%. So a 30% rise involves going to 1.3%. And as you can see from this little diagram, that really is a drop in the bucket compared to some of the large swings we've seen in delinquency rates over the last 40 or 50 years. Okay, so that's obviously a top-down view. And so it's important that we dig deeper into this and try to understand. And like I said before, we're looking for natural experiments. And it's kind of like the intersection between very strong databases and the occurrence of natural weather events really comes through in hurricanes and using US data. So there's a couple of papers here. The first is the Moody's Analytics paper, which looks at CNI loans. This really corroborates the analysis of the ECB, and so it can be viewed in that context, and actually has very similar results. And this is a very impressive piece of empirical work that uses an insanely detailed analysis of perhaps the best database related to physical risk that exists at the moment. The other paper that's sort of a little bit counterintuitive is the one by Derugina, Kawano, and Levitt, although I'd encourage everyone to seek out all four of these papers and to give them a very close read. The interesting thing about Derugina is that they looked at they compared Hurricane Katrina victims to a control group, and they then looked at tax return information and were able to track the individuals as they moved away from New Orleans following the event. And bear in mind that the population of New Orleans dropped by a significant amount after the event. It turns out that the people who were most affected by Hurricane Katrina had a worse short-term income outcome, but in terms of the longer term performance, the Hurricane Katrina victims actually performed better in the long term than the control group. And the interesting thing about this is that it's kind of like the effect of the shock forced them to migrate. And then basically when they were making their decision about where to move to, they were basing that decision largely on economic opportunities. And it turns out that on average, they made good choices. So I think that's a very interesting question, interesting analysis, and something that really goes to the micro level relationships between climate risk and credit risk, and helps to put a lot of meat on the bones in terms of the detailed outcomes that we might expect from this type of analysis. But the other point to note here is that the results are mixed. So there are articles, there are empirical studies that show that there is a significant impact of climate on credit performance, but there are also others that show that the impact of climate is sort of mixed or muted or what have you. It goes the other way. And so it's important to sort of take an even-handed approach to these things and to look at both examples of empirical work that are out there. Now, I think the key question from my mind is to ask the question, why have financial results been so muted so far? And the first point to note, I think, is that if you go back to the chart from just a couple of charts ago with the credit losses that were sloping down, the interesting thing about that is that if you imagine that trend was instead reversed and you had increasing credit losses over time, the point about this is that shareholder discipline would kick in and shareholders would require managers to adjust their behavior, their performance, to ensure that credit losses remained low. And so if credit performance ever starts to trend higher, then shareholder discipline will come into play, and you will get a push towards an equilibrium rate of credit losses, and that will tend to keep credit losses in check. I should say that these are all theories and they're all testable. And so, I would encourage these types of ideas to be tested, to work out in a sense how robust you know, how likely it is that our luck will continue, and that, you know, credit losses will remain low as climate outcomes worsen through the horizon. The next set of, let's call them theories, relate to to the predictability of climate impacts. So we've got, you know, physical consequences that were predicted very accurately by the previous generation of scientists. And then you've also got climate transitions that are more predictable than we've seen in other industries. And the general point here is that if climate impact is predictable, then the point is that investors, borrowers, and lenders can all make informed decisions on the basis of those projections, and those outcomes are less likely to go off the rails as a result. So, for example, I mean, you can go back to 1981 and a paper by Hansen. Hansen was and is still the leader of NASA's climate change research project. And you can see that the forecasts that were made in 1981 have been stunningly accurate over the subsequent 40 years. So the point is that investors and lenders who are making decisions on the basis of the best available climate-related physical forecasts would have had a very, very accurate set of forecasts in their back pocket, and therefore, you know, things probably they therefore had good outcomes. This is trying to explain why financial losses so far have been so muted. On the transition side, we can imagine that the transitions in other industries, like, for example, the impact of e-commerce on bricks and mortar retail, has been much more sort of fragmentary, difficult to predict, and as a result of that, you get you know, a much more chaotic sort of impact and higher losses in areas that were impacted by things like the Amazon effect, as opposed to, you know, more sort of predictable climate-related transitions that relate to things like emissions reductions and you know, moves to sort of reduce pollution and other policy imperatives like that. So the other set of theories that you can sort of imagine that you can posit relate to hedging strategies. So one is that financial risk tends to migrate. So areas that are more at risk of climate change, the economic activities in those places will tend to migrate to places that are less impacted by climate risk. And there are also situations where there are losers, but there are also people who are winners from climate change. And so in this situation, like, for example, if half the houses on a particular island get destroyed by climate, then the value of houses that survive that event tend to do better than baseline. As a result of this, it may be possible for investors and lenders to hedge their strategies and move their investments around and so on, and as a result, lessen the overall impact of climate change on financial outcomes. So there are many empirical questions that remain unasked and therefore unanswered, and we can only speculate about stronger relationships in the future. But what I would say is that it's very important that we remain vigilant and look for evidence that risk is, in some senses, under control. And the key to this will be early detection mechanisms. So in other words, though the risk has been muted in the past, if this starts to change and if risk starts to build, then it's important that we have systems in place that allow early detection of those changes in risk. And building these early detection systems will rely on very detailed data and very detailed analytical techniques. My concern is that the current stress tests overemphasize qualitative aspects, and that these provide low sources of information, low quality sources of information that cannot be invalidated or built upon. So, for example, if I say that you know, losses on a particular portfolio will be 2%, and you say they'll be 10%, then what's the tiebreaker in that type of situation? And the answer is that the tiebreaker is provided by hard evidence. So the data will decide whether you're right or I'm right. And so ultimately, what's important here is that we concentrate our efforts on developing databases and very strong analytical techniques. And finally, I'll end where I began, and just by saying that financial strength in the face of global warming allows the greatest scope for effective action to fix the problem that is generational and that that imperils mankind. With that, Paul, I'm sorry I went a couple of minutes over, but I apologize. I hope I've left enough for questions, and I'll pass back to you. Thank you very much.
Thank you, Tony. Thank you for a very detailed discussion there. Sarah, I don't know if you want to respond to any of those points at all. Let me hand over to you briefly.
I'd be happy to. Look, there's much of what was said that I agree with: the importance of data, the importance of methodologies, the importance of making sure we ground everything we do in evidence. Perhaps I might react to just a couple of things. I think we must remember that the path from here is getting steeper. So the physical effects on our planet of going from 1 to 1.5 degrees, I think, will be considerably more noticeable than going from 0 to 1.5. And we have to have a particular eye to non-linearities and tipping points. When sea levels rise, that matters a lot. So kind of that was kind of one point. Kind of it's harder going from here. Let's keep an eye out for tipping points. And one other point, I think insurance can be a really good indicator here, a really important data source. Our stress tests that we are doing is at banks and insurers precisely to try and get a sense of what their understanding of how climate risk means, what climate risk means for the insurance that they're prepared to provide. So I think that's a rich data source too. But bottom line, deeply agree, we need to be data driven. Second bottom line, really keen to make sure that we don't get fooled in thinking that the past is a good guide to the future.
Great, thank you very much, Sarah. So let me just take you back to one of the themes of your talk earlier. You were talking about scenario analysis being fundamental to addressing climate risks. From the perspective of practitioners, what do you want them to keep in mind in terms of developing and running scenarios and understanding central bank scenarios that are put out there?
So I think I want 3 things, many of which pick up on Tony's points, actually. So I want people to be curious, and I want people to explore and think about potential non-linearities and tipping points, so that we don't make the mistake of thinking the past is a good guide to the future. So be curious as you execute. The second is to ground it in data. I think Tony highlighted nicely the risk of some people coming to different judgments on the basis of the same information. So let's try and ground all of our work in data and methodologies so we can be really clear where we differ. And I guess the third point I'd say is take that scenario analysis into how you run your business, into the conversations that you're having with your customers, so that your knowledge about the potential future risks that they may face is imparted to them, so that they can take the actions that they need to better manage those risks. Because at the end of the day, climate change is only solved when emissions are reduced in the real economy, not by stress testing the financial system. So use these data, use these learnings to drive that engagement with customers.
Thanks very much. So we have another question here that's been put into the chat, which says that the carbon price in stress tests is a shadow price that captures the carbon tax as well as new regulation. how would the stress test scenario change if the balance shifts materially in one direction or another? I assume between the carbon tax and the new regulation. Any thoughts on that?
Yeah, kind of it's a variable that we have in our stress test scenarios that people are able to switch on and off. So if you go into the NGFS scenarios, they're available on the website, and you can choose what happens with your climate policies. And what you can find is kind of how much of it is done by regulation versus how much of it is done by taxation can matter significantly, because with taxation you get revenues. Revenues can be used to help manage distributional consequences. They can be used to invest in new technology. And so you can get a sense of how those different choices can affect the macroeconomic outcomes. But to be clear, to underline the point I made earlier, I think there's much more research that we collectively can do to help better identify the right policy mix across regulation versus carbon taxes, and indeed thinking about the proceeds of that carbon tax.
Thanks. So some of the scenario analysis that we've thought about has been focused very much on the technical professionals and organizations, financial organizations, modeling the climate risks. But what types of expertise do you need from the academic sector, and possibly also from technical professional sector, to help central banks to get to grips with some of the challenges that you've posed?
So we need a huge amount of help, right? This is an unprecedented challenge where we don't have data, we don't have methodologies, and we're all learning by doing. So everything that the NGFS does is open source and available for everybody to critique, everybody to build upon. And indeed, we put 2 vintages of our scenarios out there, and we've seen significant progress in that 12 months since the first vintage, because we have learned so much from people around us. I think we are well set up to learn from the climate scientists. I feel reasonably confident that we're doing a good job on that, translating those climate outcomes into macroeconomic and financial risks. We're definitely in the world of the novel there. So much as I set out earlier, I'm really keen to ask for all of your help as we look to get our arms better around these issues and make sure that as we take data-driven decisions, we are grounding them in the right kind of analysis. So please do come to our conference. Please do help our research, particularly on translating these climate effects into macroeconomic outcomes.
Great, thank you very much. Well, there's only really time for a couple more questions, but there's one question I'd like to pick up on. Somebody is concerned about financial institutions that are possibly underplaying or under recognizing the natural catastrophe losses associated with climate change, and wants to ask what can regulators do about that, and linked with that, what about those sectors that are really quite engaged with carbon intensive sectors? Is there anything regulators can do to reorientate their focus or encourage them to change their behaviors?
So on the first, on better understanding what the financial risks are associated with the physical changes to our climate, we are, through our exploratory scenarios, aiming to put these issues on the agenda of financial firms, to shine a light on risks that are currently opaque, to try and prompt conversations to better size these gaps. Our translation of those physical risks into macroeconomic outcomes and financial risks, as I said, there's more that we need to do, the more that we want financial firms to do. But we are, through doing this work open source, through having the sort of challenge that Tony has just led us through, we are aiming to try and best size those future risks. On the point about carbon intensive industries and the role of the financial system with regards to those, at the end of the day, climate change is reduced when carbon emissions are reduced, when greenhouse gas emissions are reduced. And what we want, financial regulators, financial stability authorities want the financial system to do, is start engaging with those clients that have these customers with carbon intensive businesses, to understand how they are planning to transition to net zero. And then risk becomes opportunity, and the financial system has got a really important role to play in helping all of those who have carbon intensive businesses, who need to change their business to be consistent with a net zero world. The financial system can play a really important part in helping support them in that orderly transition to net zero, thereby ensuring that emissions get reduced.
Well, thanks very much, Sarah. We're not going to have time to ask any more questions, but thank you very much for your talk, which has really illuminated the importance of understanding climate risks and acting early. It's going to get more difficult and steeper if we don't deal with issues sooner rather than later. Thank you, Tony, for your comments too. It's been great to have your input too.
Thank you.
This is the first in a series of 5 webinars, and we will have another webinar coming up on the 30th of September, again at 1 o'clock lunchtime, by Marjun on sustainable finance in Asia. So I would encourage everyone to register for that and to tell other people to join us, and we'll look forward to seeing you then. Thank you once more. All right, thank you.